It's too bad because, boy, that was a lot of fun the last few days in January, just seeing a risk-on environment, and it all comes undone, all unravels. The news story that you mentioned before the break in Russia, et cetera, I mean, that shows you what kind of news can drive this kind of market. Oil's down 70% since June of 2014. Right now, it's skidding on bottom. I don't believe the fact that we're at capacity. I do believe that we will come into a rebalanced market sometime this year. It's a long way off, but right now we're being dictated by a lot of sentiment, not a whole lot of fundamentals.
Take us through, because you say that potentially we haven't quite reached that bottom in those oil prices. Take us through some of the bullish and bearish drivers for petroleum markets.
Well, for me, the bullish drivers would be that supply is de-accelerating, especially outside of OPEC. We have the U.S. projected to be down quite a bit, about 1 million barrels a day. North Sea down about 250,000 a day. Brazil down 50,000. And when you look at it, last year demand was very, very good around the world when you consider how weak GDP is. Speculative length at the New York Mercantile Exchange has increased. That's always seemed to be quite bullish. On the other side, or one more thing is, like, it's really just an outlier. We just have not had a risk premium in oil in a very, very long time. And with the potential for conflict or any kind of strife in the Middle East, we could see oil rocket right back up in no time.
How important is it that we do see the market returning to its fundamentals, and what do you think it's going to take to actually drive those risk markets forward? Is it going to come back to those oil prices?
Yeah, that's so well said. I mean, right now we are being driven by sentiment, and correlations between assets are high. Everything seems to be following oil. Even the U.S. 10-year is down to 187. Unbelievable. But I think what's got to happen, either time has to pass where the news that we hear every day is just going to kind of we'll get numb to it and move on, or we're going to see some kind of stability in China. I don't think things are nearly as bad there as the newspapers say they are. Emerging markets, stability with corporate bonds, especially U.S. profits need to stabilize. So any one of those things, 4 things actually, need to occur for us to just return to some sort of normalcy.
So we speak there of obviously the dismal performance for January. The question is, I guess, what now? I mean, is February likely to be a repeat of the January performance, especially that impressive rally that we saw in bond markets? Yeah,
I know. And it's hard for me to think that we're going to have another rally in February like we had in January. And last month, a lot of the rally was really due to risk aversion around the world. Towards the end of the month, fixed income rallied basically on dovish talk, and now we're back to risk aversion again. So I'm really flat duration when it comes to the 10-year yield. I'm a little scared to be long right here, but I'm not really ready to be short either. So stay away as much as I can right now.
Larry, just on the Fed, you've still got this pretty, yawning gap between, the dots. The Fed's best guess as to where they're going to go versus the Fed funds futures and what the bond market's telling us. I mean, how do you see that narrow? What does it take for the Fed to actually acknowledge that maybe that path is not going to be feasible? They're going to have to revise down their expectations for how quickly they can tighten. What does it take?
Yeah, I think it's just going to be a slow and steady process where the Fed dots, which we all know are unrealistic, are going to slowly but surely drop down to where the market has them. I am of the mind that they are going to raise rates 3 times this year, not 4 like they're guessing. The market says 1 time, and there's a 14% chance right now that they're going to raise in March. So we'll see. But I think it's going to be data dependent. People aren't talking about inflation. You got the strong dollar. Energy definitely has really kept inflation down. But if you look at our sticky CPI, which came out not too long ago, it's clear that inflation is on the rise. And for some reason, it's just not hitting the front page of the papers.
Larry, you mentioned there about the currency, and like those bond markets in January, most of those major currency markets experience major reversals, a lot of that around fears of global growth and dwindling commodity prices. What do you think February's currency price action will be dictated by?
Yeah, it's going to be dictated by frustration. I mean, unless we get some type of stability in the oil price, even if oil stays around 30, but continues to trade in a 20 or 30 cent range a day, that will provide some stability. One of the things that the currency market is dealing with is that we've had 5 countries go to negative rates. And right now, the 10-year yield is back to where it was when Japan announced negative rates in their country. So it's going to be very, very volatile in the currency space, and a lot of it just dependent on the stability of the oil price.
Just to end off, we've seen the results of the latest Iowa caucuses. We've seen Republican Ted Cruz and Democrat Hillary Clinton taking out victory there. Obviously now adding some background noise for markets. Do you think that's going to add further nerves, further uncertainty if that outcome actually becomes less uncertain?
It could, but it just seems like if you look at history that the presidential elections, or at least leading up to it, doesn't have the volatility that we think it has or we'd like it to have. It seems like the market's pretty comfortable with who's the winner is going to be. Clearly, if it's an outlier, then yeah, that would change things. But I have not seen that, and I've read a lot of history. The market just seems to take it one day at a time and seems to price in who's going to be the president.